Knowledge is information, but not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better, thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business.
Ladies and gentlemen, thanks so much for joining our ESG conference. This is a 3-day conference. We've got investors with $10 trillion registered to be doing the one-on-one meetings that are going to happen over the next few days with top companies across emerging markets and frontier markets. You might remember our first ESG reports back in 2018. It was inevitably Scandinavians who'd been pushing us to do something first at a time when, at least in equities, less than 0.5% of money was dedicated in any way to ESG issues. By the time we got involved and started writing on this, 1%, 1.5% of assets in 2018 were ESG designated in EM, in emerging markets. Today, the numbers just rocketed up, and we're at 6%. It looks faster than Bitcoin, but unlike Bitcoin, I'm confident it's just going to carry on going up forevermore. It's a huge issue, not just in equities, also in bonds. Just a week or two ago, I heard about a client in the States, a big bond fund. They're hiring an ESG specialist just to focus on sovereign debt in the ESG space. So it's a big, growing part of the business. The governance issue, I think, is something which most investors have been paying a lot of attention to for a very long time. But the social aspects, the environmental aspects are huge. Just today, we've seen Russia pass the first reading of a climate law. So this is beginning to be so significant that investors can't ignore it anymore. When we looked at it, we looked at the environmental issues and talked about, obviously, carbon emissions. We also talked about water quality. On the social side, we looked at gender and access to education for boys and girls. We looked at longevity, how long people live, life expectancy, and then we looked at governance, ease of doing business, and so on. And it's very easy when you draw up a scoreboard like this to say, well, I'm only going to invest in the countries that score best, that have fantastic life expectancy, where everyone's got 100% access to education, where it's all green, renewable power. And often that is countries like Sweden, who were originally pushing for us to do these ESG reports. But where we think you can make the most difference is by investing in the countries that can see the biggest improvement. And the players who are going to contribute to that are the banks that we've got on this panel today. And what they choose to do in terms of how they fund, who they fund, is going to make a big difference to this over the coming years and decades. So thank you for listening to my brief introduction. I'm going to hand over now to Sam Sule, who's one of our leading investment bankers and also head of our Nigeria operations. I'm going to hand over to Sam to give a little bit more detail and to introduce our panel.
Thank you very much for that, Charlie. I think DFIs inherently are ESG institutions because this is in their framework. They're trying to promote development, and using the lens of this decade, the lens is one of ES and or G. And I'm sure over the course of this panel, you would hear from the various DFIs as to how they do that. Now, we've got a select set of DFIs that essentially transverse all of emerging markets, RENCAP being an emerging and frontier markets institution. These entities have either supported corporates with ESG investments, be it equity, debt, or MES, or they've actually issued instruments also by themselves. One of the issuers here we worked with on a 5-year benchmark inaugural green bond, and with that you had to put a sustainable framework together. But I'll leave that at this point and allow the DFIs give an introduction of themselves. What I will do now is just mention who they are and their various positions, and then hand over to them to walk you through their institutions and what they do and how they do it before we move into a more panel discussion. First but not least, we've got Bertram Dreyer, who is the Senior Investment Manager at DEG. You've got Leslie Masdorp, who is Vice President and CFO of New Development Bank. You've got Banji Fehintola, who is a Senior Director and Head of Treasury and Financial Institutions at Africa Finance Corporation. And lastly, but not least, is Panayotis Gavras, who is Head of Policy and Strategy at the Black Sea Trade and Development Bank. We will pause now, and perhaps what I do now is hand over to Bertram to talk a bit more about DEG, how it sees ESG, its various frameworks, before moving on to the other panelists. Thank you all very much again for joining us, and we hope this will be an exciting set of conversations.
Thank you, Samuel. Thank you, Charles, also for inviting us, and thank you, RENCAP, for conducting this conference. I believe it's a very important one. It addresses actual thinkings, and it's a pleasure to be here and to be part. So I brought a short presentation of 4 slides, and I will lead you through this presentation through the topics: who is DEG? I will show you then what do we understand as ESG. Then I will show you another slide on impact measurement, and I will show you a case study. So let's start with the first slide. And that is after the cover slide. Please move to the next slide. So a brief overview. We've been incorporated in '62, and we are headquartered in Cologne. We are a so-called DFI, as Samuel said, and our mission is to promote private sector development exclusively in developing countries and emerging markets. So we are not engaged in sovereign lending. We are a 100% subsidiary of KfW Group in Germany, a big promotional bank, which some of you may know. It's a AAA rated bank, a big bond issuer in the international capital markets. And when you look at the right of this presentation and this slide, you see the organizational framework of KfW. We are part of the international finance. On the left side of DEG is the KfW Development Bank, which does sovereign lending. In fact, and on the right side, there is IPEX, which is a commercial bank promoting German exports and investments all over the world, and mainly in industrialized countries. So what do we offer? We offer exactly what Sam said. Sam, it's debt, mezzanine, and equity products. And we have a support services program. So for us, it is not only the financing instrument that is important, but I would call it a journey that we want to take with our clients in order to develop their systems, their professionality, in order to ensure their sustainability. To give you a flavor of what is the volume and size of DEG, I brought on the bottom of the right an overview of our portfolio, which accounts at the end of 2020 roughly 8.5 billion euros, and it's well diversified over Latin America, Africa, Asia, a small amount in the wider European region. So the new business in 2020 was around 1.4 billion, and this counted roughly 50% of projects which we categorized as climate protection projects and environmental protection projects. And behind this, you will mainly find renewable energy projects, projects who contribute to energy efficiency, projects which introduce technologies that are damaging less environment, protecting environment. So the next slide then, please. On this slide, I show you our ESG approach. We have a long history in ESG. We started effectively in 1987 by implementing a one-guy environmental department, and then we grew. We are today 16 professionals, and we introduced the S component, the social component, in 2001, and more recent, the G component in 2013. Which are the main pillars of our framework and how we act? First of all, it's the IFC performance standards, which has developed to a globally recognized benchmark for private sector E&S risk management. Then secondly, it's the ILO standards. That's the standards of the International Labour Organization. And we are member of the so-called Corporate Governance Development Framework, which is a framework where around 34 development finance institutions came together and created a framework. What does corporate governance mean? When you now look at the left, the colorful plates, those are the performance standards, the IFC performance standards. And the main components are the four above, which is risk management. That is the question how a company addresses or how does it do environmental social risk management. Then the question how it treats labor, direct labor and indirect labor. To what extent does it protect environment in emissions, in leakages and whatever harms the environment. And fourth, the community benefits that it creates. Whenever the below four are addressed, then we probably have a project with a higher environmental social risk. Yeah? So how is our process? It's basically a process, and you see that on the right, which is the origin phase with the then following clearance in principle. Then we have the due diligence phase, which enters into final approval, the contracting stage, and then the signing of contracts and the continuous monitoring of ESG aspects. So in the origination phase, we pre-categorize a project into A, B plus, B or C projects. We set the parameters of the due diligence, and then during due diligence, we do a in-depth analysis of the company and the project, and we already identify mitigation measures, do a gap analysis, see opportunities, and at that point, we are already able to introduce our so-called business support services, which is in fact a big pool of consultants which we can use in order to help a company to improve its ESG situation. And we do not only give the access to funding, but we also provide part of the funding in order to pay the consultant, which is up to 200,000 euro and up to 50% of the cost. And this is on, it's not a loan, it is a present, on a present basis. Okay, then I think I showed you all the steps. Yeah, this business support services is not only for due diligence, it's also for the contracting phase and thereafter monitoring phase, where we can extend these fundings in order to improve the situation of our client. So the next slide, please. How do we measure impact? And there I brought you a slide which shows the 5 important aspects of measuring impact. So on the left, you see this pizza, and there you see in circles, we measure decent jobs. That means, are jobs created? Are those jobs decent in quality? There enter also the questions, Charles, you mentioned, like gender, etc. Then we measure local income effects that the company or the project generates. We measure whether there is market or sector development, modernization, disrupting monopolies, etc. We measure environmental stewardship, and that is mainly what I address on the other slide. All the results enter here into this measurement tool, and finally, community benefits. And this we translate into the SDGs. So on the right, you see here that decent jobs contribute to certain SDGs. And this is, for instance, in the case of decent jobs, gender equality or decent work and economic growth. When you take market sector development, it is industry innovation and reduced inequalities. So we directly translate this and help our clients to understand what are their effects on reaching the SDGs. So the next slide, and that's the last one then, and I'm finalizing, that is the case study on Georgia Global Utilities. It's a transaction that I led. It's a bond issue that was launched in July last year. And for you to understand this topic of a journey that I mentioned before, we really did a journey with this company. We entered in a corporate finance transaction, the relationship in 2017. We exactly improved together the environmental social management systems through introducing an environmental social action plan. And then this company matured, became more and more professional. And the bond issue last year in the end was the ability to tackle the international markets and to do this with a green bond stamp, which was not done by DEG. It was done independently by a company that has certification capabilities, but it shows you that this journey led to a success for the company as being the first green bond issuer from Georgia. Thank you very much. That was my presentation. I hope it was not too long and you enjoyed it. And I'm happy to answer your questions.
Thank you very much for that, Bertram, and I think that was very clear and concise. Perhaps we hand over now to Leslie Mastorp of NDB to go through how NDB looks at ESG from its perspective. Thank you.
We've had a few communication issues because Leslie's had to move out of his office in China somewhere else. I don't know if he's not there. I'm just going to briefly go through 2 or 3 of his slides, but obviously not as well as he would do himself. Leslie, are you there?
Shall I continue and see whether the sound, if indeed there's further disruption, then you just on my behalf present some of the ideas on the slides. I'll just start off by saying 2 things about the New Development Bank. We're an institution very green in character, in the sense that sustainability is hard-coded in our very essence, in our legal construct, our articles of agreement. The bank has, in every respect, in all of its operations, embedded sustainability from, indeed, our markets was in the green bond. Last to mention, we issued. The second point to make is to endorse what Sam said earlier on, and that is that multilateral development banks have, by design, because of our mandates, because of our public good mandate, we are in every respect to give effect to the sustainability agenda. And I predict that over the next few years, we will see banks like ours moving almost exclusively in terms of our capital markets activity to the green, social and sustainability format. At the moment, we issue bonds also for general corporate purposes, and then we have earmarked allocations for ESG-related activities where the use of proceeds is for, let's say, renewable energy or water-related projects, energy efficiency, and so on. Given the drive towards carbon neutrality and all the commitments made by not only the developed world, but now most of the G20 toward the 20 carbon neutrality objective when they will reach peak emissions. It is very possible that we will see a shift and a very a major sort of historic turning point happening in the next year or two after COP26 takes place later this year. Let me now go to slide 1. And what I want to highlight here is that emerging markets have very different starting points. If you compare China, just to give you 2 or 3 quick statistics, in China, the renewable energy grid moved. In 2000, you only had something like 75 gigawatts of renewable energy. That increased 800% over the last 20 years. Today, China has the largest renewable energy grid in the world, larger than the US as well as the European Union. If you look at the electric vehicle market here in China, whether it be passenger cars, 50% of global sales are here. The bus electric fleet, 90% of the world's fleet are here. But other emerging markets are in a very, very different state. The first bullet, I make reference there to the fact that if you look at Africa, given the large deficit of power in Africa, an Oxford study projects that Africa will need to double or will double its power generation by 2030. Yet fossil fuels will still account for 2/3 of that total. It just shows you how much of a different starting point the African continent has. What that will do over the next number of years is lock in carbon emissions for a much longer period. So the African continent has a particularly steeper hill to climb. Another very strange statistic for those of you in Africa, and yet the United Kingdom has more solar capacity than the entire African continent at this point. Next point I'd like to make very briefly is that there's been a major focus by the IMF, by the World Bank, and they use the language of building back better and also building back greener because of the sort of unprecedented amounts of fiscal stimulus that have been raised during the course of 2020 as a result of COVID-19. There's been a push by policymakers to ensure that there's a lot more focus on making that recovery a green recovery. Obviously, interest rates at its lowest point in historical terms. This is obviously a infrastructure in particular. If I can go to the next slide, what I'd like to just highlight, and it's also a theme here at the WOW a meeting here of business leaders and governments here in Asia, is a major focus on trying to get a little bit more standardization within the ESG space. What has happened over the last number of years is a proliferation of green standards. Many stock exchanges have green standards all over the world. Central banks have issued green guidelines, finance guidelines, and it's created a confusing context for investors. So it is very important that a process begins to have a lot more harmonization. Hopefully at some point we might arrive at all know what does it stand for in a narrow and in a broad sense. What does the S stand for and what does the G stand for? Each of these has to have different weightings in the different standards that exist across the world. This regulatory convergence that is required is also required within the institutional investor community, because unless there's a process also amongst investors, not only to get comfort but also to signal preferences, we will not be able to make significant advances. The next slide, please, on NDB. The New Development Bank is part of our new focus. We intend to make the crowding in or mobilization of private sector capital for green and sustainable investments our core activity going forward. We already have 70% of our investments of our $28 billion today on 73 projects are all in the sustainable format. going forward, given that multilateral capital structures that over time will have some limitations in terms of the institutional investors in our effort to expand the infrastructure footprint. I make reference also on that slide to the extent of green issuances in the world today. Most recently, we had the Italian government issue the largest single sovereign green bond for $8.5 billion, which was 10 times oversubscribed. It shows you how embedded the green and sustainable financing format have become in some of the developed markets, in the case in Italy. This bond, for example, equals the entire green issuances. It just shows you how much of a distance emerging markets still has to travel. The same with France, who before had the largest sovereign green bond, but in total, the French government has issued $40 billion of green bonds, and that represents 50% of all emerging markets sovereigns combined. Final point I'd like to make is that this recent bond that the New Development Bank piloted, an SDG bond, is likely going to unleash a momentum of issuances here in China, because there's been so much interest from investors wanting to understand how exactly the measurement is codified. And maybe just to end off, I would say that impact measurement has also become a huge industry. Again, there is a need for standardization so that you do not have multiple standards creating confusion. Many of our peers, many of the multilateral banks, EBRD, IFC, the World Bank, Asia Development Bank, each have their own unique standards, although there's considerable overlap, but still it is not a single set of standards. So both at the level of regulation of what is E, what is S, what is G, and then also how impact is measured, both of these require standardization. I'll pause there. Thank you very much.
Thank you very much for that, Leslie. And that was also quite clear, talking about your experiences in the capital markets, as well as what you're seeing in your key focus regions is quite enlightening. At this point, I'll hand over to Banji Fehintola, who is the Senior Director, again, at AFC, and has accessed the markets for green bonds and set up a green framework in line with their goals, as well as an institution supported a lot of infrastructure on the African continent in an ESG way. So we'll hand over to hear his thoughts directly and take it from there. Thank you.
All right, thank you, Samuel, and thank you to Renaissance for inviting me and putting this very important, conference together. I also have a couple of slides. I don't know if that could be shown, but if it's not shown, I will just talk more broadly around what AFC is doing and how important this subject is to us. So AFC was founded in 2007. Unlike my colleagues that have spoken before me, we are a fully African institution. We are multilateral. And so, Africa is important. It's our turf. I mean, that's the only turf that we know. And so for us, when we look at ESG, the first thing that comes to mind is what happens on the continent. We know that Africa actually is disproportionately affected by the consequences of climate change. And then there's a lot of data that also shows that Africa isn't really the major or the main contributor to some of the negative impacts that we're seeing. But in terms of impact, Africa suffers a lot. I mean, we see that with droughts, we see that with famines, and we see that with all sorts of things happening on the continent. So ESG obviously is extremely important to an institution like AFC. We primarily do infrastructure finance. And so, as you would imagine, in the sectors that would operate, the whole idea of ESG has to be important if you're heavy in infrastructure. So we do heavy industries, we do power, we do transport infrastructure, we do telecoms, and we do natural resources. So across all those areas, then it's quite important for us to put a lot of emphasis on governance, on sustainability, as well as the environment. How do we do that? It's really part of our investment process. So I think when we look at investments, from the beginning, when we're identifying the opportunity, even before that, because we do quite a bit in terms of project development, we spend a lot of time trying to address the ESG risk in each project. And as we look at projects and move them through our investment approval process, it's extremely important, apart from the project being bankable, the project being, ticking all the commercial viability and all that, we have to ensure that the ESG box is well covered. So we do take that whole process very seriously. We have independent risk managers who spend all their time, independently evaluating projects and, advising management on the ESG part of the project. And until all those things are satisfactorily addressed, those projects don't move forward. So for us, it's extremely important that in every project that we do, we ensure that we tick all those boxes. And it's not really just the projects that we do. We also put this kind of requirements on our borrowers. Again, for us, I'll talk about financing in a bit. Some of the things we are bound to do is to ensure that our sub-borrowers are also complying with the highest possible standards when it comes to ESG. So when we lend, we also do spend a lot of time working with borrowers, particularly in our part of the world where, ESG is still just catching up. We spend a lot of time educating them, providing assistance, and ensuring that, even all our sub-borrowers meet the highest standards when it comes to ESG. All through our investment process, we have a very unique construct. Our chief risk officer, for example, has a veto right, and he can veto the investment. He can veto the investment at any point in time. And so, really, when we look at it, that's how we look at ESG. Like I said earlier on, there's a couple of slides. So maybe if you just flip through some of the slides, going to the second one after the cover, so that everyone is on the same page. Okay, so we have a sustainability strategy. I've just talked about that. But the most important thing is the fact that we see ourselves as a leader in this space. So I'm talking on slide 5. As far back as 2015, we got accredited by the Green Climate Fund, and we're proud to say we're the first African institution to be accredited by the Green Climate Fund. And since then, also, we've been participating in the Global Innovation Lab for Climate Finance. And in 2019, we took the bold decision to actually start, measuring developmental impact. And so we actually came up with our DI framework in 2019. And what that helps us to do is to on a more granular basis, to quantify the impact that we're having through the projects that we do. On the next slide, it just kind of explains how all this feeds into our financing. So our investment process creates all sorts of potential green assets or sustainable assets. And we all do know that, in our interaction with the capital market, there's a huge pool of funds looking for investments in, green bonds, sustainable bonds, etc. So it is our duty, at least my duty, to ensure that on the back of all this pool of assets, we're able to mobilize green financing. And we've done that successfully. I will show you a case study. Last year was the first time whereby we issued in green format. We did issue a Swiss franc bond last year, and that bond was highly successful. I present a case study on that on one of the slides. Maybe if you move to slide 9, I'll just talk about it on slide 9. And when we're considering issuing in green format, the key thing for us was what exactly would be the underlying assets. We had a Djibouti wind farm, so a wind farm that we developed in Djibouti. We developed Africa's first wind farm, commercial wind farm in Cape Verde. On the back of those assets, plus the hydro project that we're doing in Cote d'Ivoire, we were able to access the Swiss franc market. And my understanding at the time is we were the first supranational out of CEMIA to actually issue in green format in the Swiss market, which again was a record. We had over 30 investors, several of them were new investors. And for us, that helped us to achieve a major objective, which is really to diversify our funding sources into new investor bases. So I think the key point for us is ESG does pay off. Having that as part of your investment process obviously leads to a new pool of funding. It leads to several possibilities, as our case has shown. And in fact, when we did issue our green bond, we're actually able to issue way inside our dollar funding curve. So for us, that obviously opened up our eyes to the possibility in terms of saving in our funding cost as well. So I think broadly speaking, I just wanted to leave the message that ESG is quite important for us on the continent. AFC is one of the market leaders, one of the voices, promoting all this on the continent. We've done several projects. I'm not going to bore you with some of those projects, but I did mention, the wind farm in Djibouti, the wind farm in Cape Verde, and several hydro projects that we've done, as well as several other, beneficiation and special economic zone projects that we've done in Gabon, Benin, and so many other countries as well, which again are addressing the S and the G part of ESG. So I would just pause there, and obviously we'll be happy to be part of the panel and address further questions there. Thank you.
Thank you very much for that, Banji, and very clearly on that green bond. Remember it being a strong success, and the greenium being there, you being able to pierce inside your dollar curve for that funding. And we'll hand over to Panayotis Gavras now. I think when you look at the regions that Panayotis and the Black Sea Trade and Development Bank look at, we've seen social bonds as well as green bonds out of those markets in all currencies. We've seen dollars and we've seen in euros. Us as RENCAP have acted as advisor on some of those bonds from that region. But it will be good to understand how you see ESG evolving and what BSTDB's role is in that as we move forward. Thank you.
Thank you very much, Samuel, and thank you to Renaissance Capital for the opportunity to speak to you today. The short answer to what you posed, Samuel, is that 10 years ago, we're simply not having this discussion, this event today in this region. There's nothing to say, whereas today there are some interesting things to say, and we'll try to get to that and through the Q&A that we'll have later. Let me just say a couple of words about my institution, the Black Sea Trade and Development Bank. It is a sub-regional development bank that involves 11 countries that stretch from the Adriatic, so we call it the Greater Black Sea region, involving stretching from Albania, Greece on the Aegean, to the littoral countries of the Black Sea, the ones that you'd expect: Bulgaria, Romania, Turkey, Georgia, Ukraine, Russia, as well as the Caucasus. We also have Armenia and Azerbaijan, so we actually extend as far as the Caspian Sea, and sometimes I say we're more an ABC bank, Adriatic, Black Sea, Caspian, than anything. But we were created in the 90s. We became operational in 1999, so we're relatively new in the development business. I think New Development Bank is younger, but the others have been around a lot longer than us, with a dual mandate: promote economic development, but also regional cooperation. The countries that I just mentioned are extremely diverse. They're diverse in terms of their size, they're diverse in terms of their geomorphology, in terms of their cultures, in terms of their geopolitical orientation, which is a challenge sometimes if you've been watching the news lately, in terms of their economic development, in terms of their economic structure. We have energy exporters, we have diversified economies, we have more agricultural economies, we have very service sector-based economies. So it's a very, very diverse picture. Where we are in terms of size, we're probably the smallest of the four that are on the panel today. Our balance sheet is around 2.8 billion euros right now, with an operational portfolio of about 2.2 billion, which tends to turn around fairly quickly. We have new project commitments. Last year was a bit slower because of a lot of investments being put off on account of COVID, and we're around 620 million euros. But the year before that, we were over 900. You take a midpoint of that, 750, 800 million a year, that gives you an idea of what we've been doing in recent years on average. Of that sum, when we look back with my colleagues in the environmental office, and I take note of the fact that Bertram mentioned that 15 years ago he had one person at DEG working on the environment. We have two right now, of whom one is an intern. He's an excellent intern. He's very strong, and I hope he stays on beyond that. because he's really providing a lot of value. But we are at a rather more nascent stage. Anyways, in talking with them, we saw that actually around a quarter, 24% is the number we had of our portfolio has qualifies under the environmental moniker. What I want to do as I get into the ESG discussion is actually take a step back and approach it from a slightly different angle, because these are three very different things. And the more I look at them, they are extremely different. I don't like to lump them together, to be very frank. I know they've grown in prominence more or less at the same time, concurrently. I don't know, that has part of it to do. Part of it has to be with the fact that they grew up, they had origins in many cases outside of the business world, in activist circles, outside of the business mainstream, so to speak. And perhaps that's one of the reasons that they're lumped together, but they're actually three very different things. And I'll go maybe backwards. The governance is something that is not new at all. It's something that has been there for many years. It's been there for decades, in fact. It's changing in form, but certainly when we're looking at investments that we're going to do, we look at key governance issues. We see how an institution, how a firm or a bank is run, how it deals with its clients, how it deals with its shareholders, what its ownership structure is, how transparent it is, what links it has. These things have become a little bit more tricky in recent years with things like know your customer details, and a bunch of European directives, the anti-terrorism and money laundering edicts that have come through in recent years. But those are common sense, and they're more or less internalized into the process. And I think it's something that companies are well placed, investors are well placed to look at as they go forward. The one that is least well defined in my view is the social one, because it can mean many different things to many different people. There are issues that are very cut and dried. I mean, access to education is one of them. Forced labor is another, things like that. But there are other things such as child labor, which, for instance, everybody says it's a very bad thing, but we know that many institutions in some of the poorest countries had to come to terms with the fact that they were driving away, they were driving underground certain firms, and they realized that it was more important to try to regulate the child labor process to make sure that standards were upheld, that the children had access to education and things like that. So it's a much less cut and dried area. And there's some things which are very controversial right now. I think some of the things that are discussed in Western Europe or the United States in this particular region wouldn't play very well. Animal welfare, for example. You're saying, what does this have to do with the development institutions? There have been protests, there have been things. We've received even some emails saying, what are you doing for this sort of a thing? And the answer is, it's not on our radar. It's not something that we're focusing on. In terms of jobs that we create and all of that, those are standard metrics that our evaluation people have been looking at for years, and other key positive externalities. And that's something that we see as being very important, obviously, as a development institution. We also look at regional cooperation elements because, like I said, we come from a region that was very diverse and not very well connected, the countries with each other. So that's something that we pay particular attention to. And that actually leads me to the environmental side of things, because as I said at the beginning, 10 years ago, that was not on anyone's radar screen really in this region. It was at a very, very nascent stage. It still sort of is, but you can see the countries are developing frameworks for environmental type of operations. They understand the importance of things. Almost all of them, there are one or two exceptions, have signed up to the Paris agreements and have made commitments to cut their emissions going forward and to improve their energy generation mix and all of that. Some of them have seen a geopolitical imperative to do this also because it makes them independent from certain other countries in doing so. But there's been an investment boom that has started. It's not even, some countries are ahead of others. But even in a country like Greece, which went through a huge crisis in the previous decade, which we all know about, whereas there was no investment to speak of in most sectors, renewables were actually booming. And right now, the country, about a third of the country, even higher, is on renewables, and the trend is upward. So it's something that 10 years ago simply didn't exist, or it existed at a cost that wasn't workable. And now we're seeing these countries really going forward. And we're seeing that a lot in the kind of projects that we're getting the proposals. We work mainly with private sector companies. We do not have an ex-ante preference for public or private, but in practice, we work with a lot of medium-sized private sector firms. And the renewable energy generation is something that we've seen a lot of projects in recently, to the point where at one point we were wondering if there's a risk that we might become too exposed to it. And that was a very passionate argument, because we have risk management people who look at certain numbers in a certain way. And we had other people saying, you know, this is an investment boom. This is something we need to get in on. It's very important. The positive externalities are substantial. And then we realized that one of the things that we didn't really have is a framework to look at this through very, very systematically. We recently produced a climate finance strategy, which is a huge step in the direction of systematizing the way we approach these things and how we're going to do it. We are currently in the process of incorporating, for instance, carbon accounting, which we never had before, into our process. So like I said, we're at a more nascent stage than some of the other DFIs that are active in the region. And that's something that will be on board in coming years. And I think it's a very good thing, because these are measuring, it's another way of measuring these very important externalities that need to come into play. We are a region also that has relied heavily on coal. There's a lot of sunk investment in fossil fuels. And the countries want to move in a direction of being cleaner, but they're also very wary of the investment costs that they've put into things, and working with institutions such as DFIs to get over this is a long and quite involved process. I'm going to stop here. I don't have a case study to speak of. Like I said, overall, we've seen a sharp rise in recent years, to the point where our risk managers are wondering if we might even be breaching at some point limits. I can tell you we are not. I wish we were closer to those limits than we are. But I'll be happy to, like with the rest of the panel, to take any questions you might have. Thank you very much.
Thanks very much for that. That was. I've got quite a few questions for a number of people. I just had to say, on the Cape Verde wind farm that the Banji was talking about, I had a holiday there once. It was the windiest place I think I've ever been in my life. As long as you were tucked behind a wall, it was beautiful. The sun was out. It was amazing. So I can imagine that was a very successful project. But I wanted to ask first, Bertram, DEG, you've been doing this for a long time. You gave us a case study of the Georgia water project, I think it was, or hydroelectric, but that seemed like it took quite a while. And I'm just wondering, what difference does it make when you're adding in all of these ESG components to a loan? Do you feel it's added 6 months to what was an 18-month approval? Is it now 24 months because you've got to check the indirect jobs aspect? And I'm just curious about, well, whether you've noticed an impact, or whether it's so internalized now at DEG that you have to do it anyway. It doesn't make any difference. But I'm just, compared to say 5 or 10 years ago, is it taking longer to get a loan done?
Yeah, Charles. No, it doesn't. In fact, I think we have become more professional. We are more focused. And the question really is very well at the beginning. It's what is the current situation of the potential client? And what is the client's willingness to start this journey together with us? And when you have an agreement at early stage and the company has already done certain steps forward, then this can be a very short process, because we conduct a gap analysis with regard to ILO, IFC performance standards, corporate governance, and then we focus during the contracting phase, and also after disbursement, we focus on certain gaps and opportunities within the company. And we do not do this because we believe ESG is modern and you should do it. No, it's an integral part of our process, with the strong belief that you only are able to have a resilient and sustainable business if you address these three components. Yeah, that's our clear belief. And we've seen that in crisis, for instance, when corporate governance is weakly developed, we see that companies are less resilient and tend to leave business because they are not well prepared in critical times.
That's and I think that's a sense that I'm getting from quite a lot of investors in public equities as well as other corporates, that these companies need to be thinking 5 or 10 years ahead, and that does mean taking into account each of the ESG angles. The other thing that came up, and it partly came up, Banji, because of what you said, that you were able to issue a bond more cheaply. So that's the positive side of the question, but there's a negative side and a positive side. For each of you, I'm curious, have there been projects in the last year or two that you've said, can't do this? It's not going to meet the ESG criteria, and we have to rule it out. And that might be too sensitive to say on this panel, but I'd be very interested if any of you could touch on that. And the second aspect is, because perhaps of cheaper financing from ESG, bond, or the funds that are ready now to lend to you more cheaply, are there projects that now become possible because of that cheap ESG aspect? If I could start with you, Banji, has there been any projects that you've stopped with, and then anyone else can interrupt after that?
Yeah, so to be honest, there have been many, not just one, not two. There have been so many projects that have come through the door, and for several reasons, it could be environmental, it could be social, it could be governance. We've had to turn them back. We've seen so many on the governance side, particularly, for us, from our experience, I mean, all the challenging projects that we've had in the past, they seem to have some common denominators. Some of them had to do with, where you had some dominant family-owned businesses, people who didn't want to adhere to very, world-class governance standard. And we've learned our lessons, and as we moved along the way, so we ensured that we're not making the same mistakes all the time. So when we see such projects coming through the door, we know what to ask for. Certainly on the environmental side as well, there have been several projects where we've not been satisfied with, the ESAP or what the sponsor's commitment is towards addressing community issues, etc. And as a result of that, even though those projects were profitable, we walked away. We just had to walk away from such projects. So there have been so many. On the other side, yeah, I mean, when you talk about financing, it's quite important for us to just maintain those high standards, because I think having access to this pool of funding is important. Because, if we look at the sectors we do, out of all the 5 sectors we do, the biggest competition comes around the renewables, where, we're an Africa-based institution, our cost of funding is not particularly the cheapest. So, when we have any renewable project in Africa, you have everybody, including DEG and co, all pumping in cheap, negative, variable money into those projects, and we compete, right? So the only way we can compete is to also ensure that we have access to such funding. So DEG, for example, are good partners. We get funding from them as well. Same with KfW and several other entities. We collaborate on the technical assistance side to build capacity. So it's all collaborative, and it's important for us to have access to the cheap pool of funding so that we can do some of the renewable projects that are thinly priced on the continent.
Thank you for that. And I think from my perspective, and I think this question will go to all 3 panelists, but starting with you, Panagiotis. And when you say ESG, it's 3 different concepts, and you mentioned that in your speech. Which one carries more weight, E, S, or G? And being in emerging markets, does that impact how you look at each of those components? And then finally, how do you ensure you support companies to maximize their chances of getting funding from yourselves based on that weighting? Thank you.
Sorry, what was your last question, Charles?
The last question was, how do you support companies to maximize their chances of getting funding from yourselves? Okay.
Let me say that, let me follow what Banji said, that the main things that kill projects in our region are governance issues and sometimes the environmental ones. What we have found, though, even companies that come to us looking for money, I mean, there's some things that we won't touch anymore, things like coal, for example, coal is blacklisted. By and large, even coal cleanup things is something that development finance institutions generally are walking away from. We have not statutorily excluded it, but de facto we have. We will work with other fossil fuels, but there's really an emphasis on cleaning things up. What we have found is that clients are actually very open to these sorts of things. Even though we're not the cheapest in the world either, like Banji said about AFC, we are there, we are close to them. We are relatively fast, which I think is important. Many times you'll hear people say that the most expensive money is the money you don't have. So being actually fast is something that we pride ourselves on as we go forward. And for those reasons, they put up with us. And I think they more than put up with us. There's an understanding that they need to move in that direction. Particularly on the environmental side, we have seen that there is a growing awareness. People, are seeing what's going on. They are seeing, first of all, the fact, the reality of climate change. There's a preponderance of science out there which shows that it's going on, and that preponderance of that science says that it's man-made. I mean, there are far fewer climate deniers than there were, a decade ago. And most companies realize that this is an important issue. And I think some of them see strategic advantage of it, particularly on the environmental side with the renewables and the ability and cleanup and being able to tout the kind of things that they're doing there. In the region that we work in, we see less of that in the social. And the governance also, although the governance, those are standards that we have. I mean, those are things that you have to do for the sake of transparency, to combat corruption. I mean, those are basic things where we're not going to put our money and our name on the line if it's not clear who the ownership is, if, we don't know how the company operates, if they won't answer a standard questionnaire that we have that to our satisfaction in terms of the kind of things that they do. The social is less well defined. Again, I told you earlier I would spend less time on it, and it's clearly something that's less well defined for us because our view, it means so many different things to so many different people. Certainly our shareholders don't have a consensus on what they want from that. The truth is they don't have a consensus maybe on the E and the G also, but they understand the importance of it. So when it's explained to them, they see the opportunities that these sort of things have. They are much more open to that side of things. So if you asked me between those three different things, the environment and the governance are the ones where I've seen the most progress, the most standardization, the most institutionalization. Leslie was right when he said that there are many different standards out there, but we also know that there's a big move to harmonize standards, to harmonize reporting outcomes so that people are trying to look at the same things and not asking clients and governments to do a million different things all the way around. There's a big push in that direction. And there is good faith behind it. I mean, there's bitter arguments sometimes, but people understand that there's an imperative behind it, that it would lead to a very positive outcome. And I'm optimistic that certainly on the environmental side and in some of the key governance issues that have come up in recent years, you will see common standards emerging in those. The S, I feel less qualified to comment on.
Thank you. And perhaps Banji and then Bertram on that same question around ESG, the weighting, and how you support companies and corporates in accessing funding from your institutions.
Okay, maybe I can go first. So for us, it's being an African institution, right? And I think I made that clear during my opening remarks about how Africa is affected by the impact of climate change, etc. So the environmental part of it is quite important. Governance is important. Social is equally important. I mean, we're talking about a continent that is that has young people, growing population, probably the fastest growing population, obviously, in the whole world, and yet does not have access to just the basic things of life, right? Poverty is rife and inequality, all the basic SDGs and all that stuff. So for us, addressing those things through our project becomes extremely important. I think I always joke with people, I say, one of the benefits of operating in Africa is almost any project you do will address the SDGs. So it's that bad that it's so easy for you to just do anything and you are solving problems. So I think from that perspective, yes, we look at the three pillars and we don't quite discriminate between the three pillars or put some emphasis on one or de-emphasize the other. So I think it's really a combination of all that. The second part of your question was how do we support institutions to move in the right direction? We work with sponsors, we work with anyone who's trying to borrow from us. We do have a very strong project development business. Part of the development cost obviously is what you spend on ESG and ensuring that the ESAP and every other thing is well in line with global standard. And of course, it's just part of the cost of doing business now. We make people realize that. We finance it. We take very early stage risk in some of these projects. And eventually, when we get the project to a high standard that meets global benchmarks, international lenders come in and then we get paid out and all that. So we work with them, we handhold them, we educate them, and all that. It's all part of our duty as a DFI. Thank you.
Yeah, thank you, Banji and Panayotis. I just want to add that I don't believe that E, S, or G is anything like one is more important than the other. It depends very much on the project, the client. There might be a small company, which is ownership managed by the owner, and the owner is also the chair of the board. And this guy treats the employees very well. The community is included. On the environmental side, the company is perfect. But on the governance side, there is an issue. And he's not willing to open the company, but he feels that it's time to open and to introduce new and external know-how. Then G might be the most important. So what I want to say, I think what is important for all of us, we are in a very disruptive phases of humankind. We have climate change challenges. We have the pandemic, which showed that we are quite vulnerable. We have the digitalization in front of us, and companies which are in a position where they address these challenges, companies which are able to react flexible, which have a good performance on the social side, include communities, motivate employees, etc., are more resilient. And that is our approach to work together with corporates, financial institutions, infrastructure projects who have this mindset that they believe ESG is important in order to be sustainable. And then we can come together, we have an alignment of interest, and then we help them and support them in order to reach this goal. And the example of Georgia Global Utilities, there was a long process, Charles, that's right. But in the end, the bond issue itself, because we knew each other, was very fast. It was three months and this bond was launched. Yeah, but the process before took some time, but it was worthwhile because the company afterwards is more resilient, access new investors bases. So it's really, I believe it's a benefit.
Thank you for that. And perhaps we'll start with you on this next question and then Banji, and that's really around sustainable funding and what your experiences has been for the investors that are listening in, and what your expectations going forward would be in tapping the markets for ESG compliant instruments.
Sorry, could you repeat the question?
The question was around accessing sustainable funding, what your experiences have been, what frameworks you have in place, and how you view this as we move forward from a funding standpoint. What percentage of ESG do you think your funding will be, and how large do you see this market becoming?
Okay, we are currently undergoing a sharpening of our profile, and the issues are impact and climate. And so what DEG is currently undergoing is discussing when should new business be climate neutral? When should the portfolio become climate neutral? This also is an internal journey that we are starting. Our funding base is basically the bonds issued by KfW in the international capital markets. When it now comes to, get funding from international capital markets for the projects where we invest in, then this bond issue is a good example, because in the end, we see ourselves there as a cornerstone anchor investor, where we give a stamp on the bond issue saying, look, this is of good quality, and you investors who are interested in impact, climate protection, etc., you can be confident that this asset is of good quality. Yeah. So I think what we are discussing here will become more and more important, and we are pressed, I would say, encouraged by the developments that I mentioned before: the pandemic, digitalization, climate change. All these issues are very important, and we have to be prepared.
Thank you. That was very clear. Banji?
Yes. So thank you, Samuel. I think that's a very important question. And then, I did mention earlier on that we had our debut green bond issuance last year. We did that in Swiss franc. Obviously, it's a market that we have active presence in. So that's our third bond issuance in Switzerland, and we decided to make it a green one. Again, we saw significant uptake. Book was massively oversubscribed, lots of investors, and we saw a pricing advantage. So for us, that was an eye-opener. And in leading up to that, we put together a green bond framework, which again describes how we go through the process of identifying green assets, how we monitor even after we funded, and how we do the reporting, etc. So we are an institution that's taken note of what is happening and the demand from investors towards ESG and sustainability generally. And as part of our funding plan now and our funding strategy, ESG has become quite important. And so for us, future issuances, even though we will be doing the plain vanilla type of issuances, we will be looking to play along the entire spectrum. So it's not only green bonds. We could do sustainable bonds. We could do some transition bonds. We could do so many things on that whole spectrum. In addition to the bond market, obviously the loan market is important. And I did mention earlier on that one of the climate finance type of funding we first had was with AFD out of Paris. That we have been using for quite a number of projects. We are accredited with the Green Climate Fund, so we're working with them as well to tap some funding which will be used to finance some renewable projects on the continent and so many other pools of funding like that. We want to be the catalyst for people that are looking for funding on the continent, as well as people who are looking for renewable types of assets on the continent. So we position ourselves as a conduit for global capital onto Africa. So I think broadly speaking, you'll be seeing a lot from us on the sustainable side, on the ESG funding, and potentially even looking at a benchmark dollar type of green bond issuance in due course.
If I could jump in with a last question, because I know we're getting close to the end of our session. One of the things that I keep on coming across are companies that are a bit smaller, medium-sized enterprises, and they raise the common issue that you get in so many low-income countries about access to finance. I'd love to send them your way, but I'm just curious about how small a loan does each of your banks do? And then thinking about SMEs and the fact that perhaps they are too small to get funding from you, but perhaps it would still be useful for them to see the sort of ESG framework that in the medium term, let's assume they get big. And I think a lot of companies will be getting big from Pakistan to Nigeria in the next few years. Do you have frameworks on your websites about what you recommend, in terms of ESG frameworks, what companies should be thinking about? So even if the companies are too small to borrow from you now, perhaps they could be thinking about it in the future. So there's two questions again. How small a loan do you do? And then do you have something on your websites to educate not just the big companies you already talk to, but the SMEs? Start with Banji again, but I'd love to hear from Panayotis and also Bertram.
Banji, do you want to start?
Yeah, so I'll start. Good question, Charlie. To be honest, we are not a retail bank, so SMEs and co, not quite our space, to be honest. It doesn't in any way say, SMEs are bad or anything, but SMEs are engine of growth. I mean, there's a lot of data that shows how important SMEs are in driving growth across the world, and I don't think Africa is an exception. What we try to do is to finance SMEs not directly but indirectly through financial institutions that focus on SMEs and they do some of the things. So we see financial institutions as an extension of what we do. So we do actually give lines of credit to financial institutions for on-lending to SMEs. And as part of that, we also do ensure that those financial institutions adhere to very high standards in terms of ESG, and they pass that on as well to their sub-borrowers, which are the SMEs. And we also try to share ideas. We try to, do some capacity development from time to time, and just essentially, I mean, we don't do technical assistance like DEG, at least not at the moment, but we volunteer our time, talking to FIs, building their capacity, and then they can pass on that capacity to the SMEs. So that's really how we play. Our ticket sizes are big. It's not SME level, but we go through financial institutions.
Panayotis, do you want to continue, or shall I?
A similar response to what Banji said. First of all, SMEs are the main type of economic entity in our region. Among the countries that I mentioned are some very small economies, places like Albania, Moldova, Georgia, where by any standard, companies are considered even micro, below small and medium enterprise level. Look, we'll go as low as, we say 5 million formally euros. Informally, we'll go even as low as 3 million in some of the smaller countries. That still is too big for some of these companies. And therefore, using financial intermediaries, like Banji said, for his countries, for the countries that he works in, is very important. We have a network of relationships with institutions, with financial institutions, through which we go in order to provide financing to small, medium, and even micro enterprises, as they may be. We have not really gotten into themed lending. It's one of the things that we're discussing. You can do things like SMEs for energy efficiency and things like that. There's an endless array of things, and our financial institutions people could talk about it much more eloquently than I can, because that's not my area of expertise. But I know that they've spoken about theme-based lending. We've decided so far not really to do it because we're quite small. And we don't have technical assistance of our own. We have attracted some ad hoc funds, but it's not so much. Compared to the sums that some of the other multilaterals are using in this region, and the access to funding that they have, what we have pales by comparison. So that limits our ability to do sort of grand technical assistance type of things. And we prefer to work with companies on a case-by-case basis, working with them to upgrade standards environmentally. Sometimes it might be something as simple as converting accounts to international standards, which is more on the governance side, and helping them that way improve their access to financing going forward from other financial institutions after they've worked with us for a while. So I would say it's a very similar situation to what Banji mentioned, and we can go quite down to what I think is a quite small number, the 3 to 5 million range. But still, you'll see that for a lot of companies that is too much, and you really need to be creative in the way you go about it, working with local entities, local funds, as the case may be. Equity is something that we have not discussed today, but that's something that our institution can do. We've done it sparingly because, well, credit rating agencies risk weighted very badly, and it limits our ability to do other things. That's an unfortunate limitation that we face, but we have done it. We prefer to do it directly. You can also do it through funds, but when you do it through funds, you lose an element of control, which is very important, which is also true of SME things. I mean, lending through financial institutions for SMEs has a number of tricky elements in terms of controlling where the funding ultimately goes. And that's something that we're working on, improving and making sure that some of the standards are there. But I'll tell you very bluntly, it's a work in progress. We're not there where we want to be.
And I think all has been said, really. It's loans through financial institutions, equity through private equity funds, and then you access SMEs. Yeah, and then if you combine this with the technical assistance or business support programs, which we do, then you start to access small companies and train them in order to get prepared to grow and to cope with the challenges ahead. Yes, yeah, that's more or less the approach. And we work closely together as well. You will see Black Sea Development Bank, AFC, DEG working together in transactions as well. It might be that we now seem to be different institutions, but no, we are co-financing institutions. We work closely together. We exchange experiences. I think that's also important to mention here.
Let me take up that point. We have worked with DEG, for instance, over the years, and with New Development Bank. We don't have a geographic overlap, so Africa Finance Corporation, not so much. But it's a very important point that Bertram raises. Another thing that's going on, I mean, as development institutions, cooperation is part of our nature. We love to cooperate. We certainly love to talk also, as you've probably realized today. And one of the things that we like to do is get together thematically among ourselves and discuss these sorts of things. So there actually has been a lot of progress in harmonizing standards in a number of areas. And people will tell you more needs to be done. And that's certainly true. But I think we're also much further along than we were certainly 10, 15 years ago in terms of the recognition of the importance of these things and understanding that we need to be client friendly. We realize that the clientele that we work with, particularly private sector clients, have many, many alternatives. They don't need us. They'll come to us only if they want to come to us. So we have to be responsive and have this value proposition for them that differentiates itself maybe relative to what they can get from some of the others. So yeah, there's a lot going on behind the scenes also that is not evident. I'm glad Bertram actually raised what he raised about talking among ourselves and the kind of things we do and working together.
Thank you very much. Over to you, Sam.
Thank you all for I think we have come to an end. We've heard from the various DFIs on here, their various perspectives on ESG, how they're supporting the various regions, whether it be globally or across emerging markets, Africa and the larger CIS region. And I think what we've heard is the various points that are required from an ESG standpoint. We've also heard about their funding plans, how they view life within this decade, and how we expect ESG to remain a part of what the landscape is. We'd like to thank the panelists here for participating and sharing their views, as well as giving a lot of the insight as to accessing funding from themselves, as well as to the investors as to how they plan to continue to access markets going forward. We thank you once again, and I'm sure this panel has been exciting for all of those listening, and we will continue to engage either as RENCAP or as various institutions in ensuring that we do build a more sustainable future for all, particularly for all in emerging markets. Thank you all once again, and we look forward to further engaging as we move forward. Thank you.
Knowledge is information, but not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better, thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business.